Hi, Brock VandenBerg, President of TaliMar Financial. It's the end of the week, and I wanted to end with a quick update as to why I increased my investment this week in the mortgage fund by over $250,000. In this video, I'm going to give my top 3 reasons why I added to my investment, and I continue to add to my investment, and explain why I think the current volatility in the market has created opportunity not seen since the housing crisis since 2008. Before I get too far, however, I would ask that you subscribe to this channel, and if you've not already, give this video a like. Also, please feel free to leave your comments below. The first reason that I increased my investment in the mortgage fund is that we've been able to increase the overall return of the fund by over 100 basis points, or 1%. That compares with a year-to-date return of the S&P 500 of negative 18%. In January, we returned a healthy net 7.25% annualized return to our investors. By July, we were able to increase that return to 7.5% by funding higher yielding loans. By October, we'd increased the return to the investor by over 8% by selling lower yielding loans in the portfolio and replacing those loans with higher yielding loans. Consider, in early 2022, our average note rate was about 8%. By October, our average note rate had jumped to nearly 10%. By December, I'm predicting our average note rate will reach the high 10% range. The second reason I increased my investment is that I am confident in the long term in the markets that we are lending. Currently, 80% of the loan portfolio is secured on properties in the San Diego market. Of the properties we lend, over 75% are single-family residential 1 to 4 units. Using figures released by the Case-Shiller U.S. National Home Price Index, the average increase in home values in San Diego over the last 30 years is slightly greater than 4% per year. That has exceeded the national rate of inflation over the same period by roughly 1.5%. The reason home values in the San Diego market and other urban California markets have increased greater than the national rate of inflation is that the demand for housing far exceeds the supply. We have too many barriers to entry for real estate developers to bring enough housing to the market in our state. This isn't going to change. No matter what housing policies California puts in place to increase the supply of housing, the time and cost to bring new housing to the market is simply too great to catch up to the demand. And honestly, this is where I am conflicted. I am a big proponent of bringing housing to the market. I plan to grow old in San Diego and hope that my children and grandchildren will be living here as well. Yes, I'm very well about the politics and the taxes, but I enjoy San Diego too much to leave. But here's my conflict. It is in my best interest, and yours as well if you're an investor in the mortgage fund, to make sure the supply of new housing remains low because it safeguards our loans from the risk of overbuilding. Now, I hear many of the reports from the media and hear from investors that the housing market is going to slow dramatically. Well, that is probably a good thing. Consider home values jumped by over 20% in San Diego in 2022. We all acknowledge that the increase was unsustainable. Many reports are suggesting that home values are going to drop 10 or 20%. I would argue that in some markets, you've already seen a 10% drop from the peak of the housing frenzy. But put that into perspective. Home values in San Diego are still up year over year by over 10%, according to the most recent Case-Shiller report. That means values could drop another 10% to bring us to break even and probably bring us closer to the mean of over the last 5 years. The reason why I remain confident in many core markets of California, why this is different than 2008, is that homeowners still have equity in their homes. Take into consideration in 2008. Back then, banks were lending to borrowers at too high loan-to-value ratios without checking to see if they really had the ability to pay. Banks did a much better job underwriting during this cycle. Second, many homeowners have locked in rates below 3 or 4%. With such low rates, many homeowners aren't interested in selling their home just to buy another home with a higher interest rate. Further, homeowners aren't about to refinance their 3% rate for a 7% rate to tap the equity in their home. I don't have the figure, but I have to imagine the equity homeowners have locked up in their homes with no way to access, by the way, has to be in the trillions. I predict we will have a much bigger issue when the market stabilizes and there isn't enough homeowners wanting to sell, driving us into a further supply and demand imbalance. And don't get me started with institutional buyers just simply waiting in the wings to buy homes as values drop. Third, with rates jumping, many potential homeowners are going to remain renters. That allows many homeowners who may have simply sold to become landlords. Homeowners who once may have sold to downsize into a smaller home will recognize the opportunity of cash flow by renting their home. Just consider the popularity in accessory dwelling units. Fourth, and most important, the job market. The job market remains strong in many core markets like San Diego, with many families having already had to move to a dual incomes to simply qualify to purchase a home. The loss of a job by one earner can be temporarily offset by the income of the other. And the third reason that I increased my investment is to show you, the investor, that I am committed to this investment. I think one of the biggest things you can show your investors is that you have skin in the game. I have personally invested over $500,000 in TaliMar Income Fund I, with monthly distributions being reinvested. There's plenty of media out there that is bearish on the economy in the near term. Some of them is self-serving, as many companies are looking for ways to reduce headcount, capital expenditures, and exit from an ill-advised investment from a tech or social media company. But the Fed is telling us that they want the economy to slow down, and you better be listening. There is definitely going to be some losers in a rising rate environment. That being said, I think a debt fund is well positioned to take advantage of the opportunities that are going to arise and capture those returns. First, many banks and other private lenders who are dependent upon Wall Street to fund their operations have scaled back their lending programs. This has left a void in the private lending market, which has pushed up rates, and as a result, the returns my investors are currently making. I mentioned earlier, our returns to investors have increased over 100 basis points, or a full 1%, in less than 6 months, without any defaults in our portfolio. We expect those returns to continue to increase as the Fed raises their rates. I equate it to when I first started lending. Back in 2008, we were in the middle of the financial crisis and lending had come to a near standstill. I could literally charge anything for a loan. At the time, I could get paid well for the risk, and as long as I felt comfortable with the collateral and the borrower, we were funding good, solid loans. In fact, I never foreclosed on one property between 2008 and 2012. In about 2012, I started to notice some new lenders had entered the market. These were fintech lenders that were more focused on the technology and less the collateral or the borrower. By 2015, these fintech firms had swamped the market with cheap capital from private equity companies looking to take advantage of the higher rates of return in the private lending space. With the private equity firms came the secondary market that would package up these loans and sell them off in large securitizations. In fact, securitizations became so popular, the amount of capital entering the hard money lending space far exceeded the need for that capital. Loan-to-value ratios shot up and interest rates fell. To compete, traditional hard money lenders had to follow the market. What I thought was interesting, however, was that even though we were forced to increase our loan-to-value ratios and lower our rates, investors were still willing to fund loans. Investors were willing to take more risk and earn a smaller return simply because they felt that the housing market was strong. I'll say it again. Investors were willing to take more risk for a lower return because of the perceived strength of the housing market. Well, the adjustment over the last 6 months have brought us back to the basics. The well-financed lenders backed by private equity have all but left the market. Borrowers who got fat and happy on 90% purchase and 100% fix and flip loans have had to adjust their business quickly. The amount of risk that I have to take to win a loan has decreased substantially. In fact, I may be the only lender bidding on a loan, and this takes me back full scale to what I was doing back in 2008. We're getting a lot of loan requests from very seasoned borrowers willing to put significantly more cash equity into a purchase. Where I was quoting rates in the low 8% range, I am now quoting rates in the mid 10% range. Where the average loan to value ratio is at 70% or higher, we're seeing borrowers accept sub 60% loan to value ratios. I am very bullish about the opportunity in the private lending space, which is why I increased my investment by over $250,000. The Southern California market that we serve remains very undersupplied and will probably fall further behind as developers pull back on building new housing and homeowners wait for a stronger market to sell. We all expected a slowdown in the market after housing jumped by over 20%. A decrease in market activity will help us all, not only to stabilize the market, but allow us to adjust our underwriting criteria and price more accordingly to the risk-adjusted returns we should be earning. I want to thank you for listening and ask you to give this video a like. And if you've not already, subscribe to our channel. If you're interested to learn more about the mortgage fund, I would be more than happy to schedule a call with you. If you haven't already, I would highly recommend that you check out some of our other educational videos and webinars that I have posted. I want to say thanks again for listening and have a great weekend.